Welcome to our podcast on ASU number 2015-16, Simplifying the Accounting for Measurement Period Adjustments. In this podcast, we will compare the current U.S. GAAP requirements to the amended guidance, give you a quick reminder of what the measurement period is, and describe the new required disclosures. My name is Paul Fayyad, and joining me in this podcast is Casey Miles. We are both senior managers in KPMG's Department of Professional Practice in New York.
Thanks, Paul. The FASB released this ASU in September 2015 as part of its simplification initiative. As such, the provision of the standard is expected to reduce cost and complexity for reporting entities while maintaining the usefulness of the information to users of the financial statements. Paul, maybe you could walk us through some of the ways the ASU will impact measurement period adjustments.
Sure, Casey. Under current guidance, if the initial accounting for a business combination is incomplete by the end of the reporting period in which the combination occurs, the acquirer reports in its financial statements provisional amounts for the items in which the accounting is incomplete. Then, during the measurement period, when new information is obtained about facts and circumstances that existed as of the acquisition date that, if known, would have affected the measurement of the amounts initially recognized, the acquirer must retrospectively adjust the provisional amounts recognized at the acquisition date to reflect that information with a corresponding adjustment to goodwill. The acquirer also must revise comparative information for prior periods presented in financial statements, including making changes to income effects as a result of changes made to provisional amounts. To simplify and reduce the accounting for adjustments made to provisional amounts recognized in a business combination, the ASU requires the acquirer to recognize measurement period adjustments to provisional amounts in the reporting period in which the adjustments are determined. The acquirer also would record in the same period's financial statements the effects on earnings of changes in depreciation, amortization, or other effects as a result of the change to the provisional amounts, calculated as if the accounting had been completed at the acquisition date.
So let me make sure I understand. Once an entity records provisional amounts in a given year, those amounts won't be revised in future periods?
That's correct. The measurement period adjustments are calculated as if they were known at the acquisition date, but they are recognized in the reporting period they are determined. Now that we've gone through how the amendments in this ASU affect the current guidance, maybe you can remind us of some basics of measurement period adjustments, Casey.
Sounds good, Paul. Let me take a moment to level set and make sure that everyone is on the same page regarding measurement period adjustments. As set forth in ASC 805, the measurement period is a reasonable time period after the acquisition date. And during this time period, an acquirer can adjust the provisional amounts which were recognized for a business combination if the information necessary to complete the accounting is not available. For example, entities may have to record provisional amounts related to a business combination if appraisals are required to determine the fair value of the tangible and intangible assets acquired, and the appraisals aren't available by the time the financial statements are issued. This scenario is fairly common when a business combination is consummated near the end of the acquirer's reporting period. It's also important to note that the measurement period ends as soon as the acquirer receives the necessary information or learns that more information is not obtainable. In any case, the measurement period can't continue for more than 1 year from the acquisition date.
Great summary, Casey. Let's walk through a quick example of how ASU 2015-16 impacts a company that needs to record a measurement period adjustment. Assume that Company C acquired Target T on the first day of October. Company C hires an independent valuation specialist in order to obtain an appraisal for the acquired PP&E. Company C's financial statements are available to be issued on February 28th of the following year, and the appraisal of the PP&E is incomplete at that time. Company C's preliminary estimate of the fair value of PP&E is $30,000, and they recognize a provisional fair value of $30,000 in the December 31st financial statements. The PP&E has a useful life of 5 years, so at December 31st, Company C recognizes depreciation expense of $1,500. In 6 months, on March 30, Company C receives the finalized appraisal estimating the fair value of PP&E at $40,000, which is $10,000 more than what it had recorded in its provisional amounts. So Casey, given that fact pattern, what is the difference in the company early adopting the new ASU and accounting for it under the current requirements?
So now that Company C has received the appraisal and it's near the end of March, under current guidance, they would go back and retrospectively adjust the December 31st financial statements. They would do this by recording an increase to PP&E of $9,500, which represents the $10,000 increase to the fair value over the provisional amounts that were recorded, less the $500 in depreciation that needs to be recognized for the last 3 months of the year. They would increase depreciation in the income statement by $500 and reduce goodwill by $10,000 since the PP&E had more value than initially estimated in the provisional amounts. Under ASU 2015-16, the December 31st financial statements are not retrospectively adjusted, and Company C recognizes the adjustment in its March 31st financial statements in the same period that the appraisal was finalized. As such, they're going to recognize an increase to PP&E of $9,000, which represents the $10,000 increase to the fair value over the provisional amounts recorded, less depreciation of $1,000, which is depreciation for a 6-month period from October 1st through the end of March. They'll record both the additional depreciation of $1,000 and the $10,000 decrease to goodwill in the current quarter financial statements. At the end of the day, the December 31st financial statements are left untouched, and the totality of the impact is in the current period.
That makes sense. So when a company records the adjustment under the new ASU, are the requirements related to financial statement disclosures the same?
So the FASB indicated in the ASU's basis for conclusions that some board members were concerned that reflecting all of the income statement impacts of the change to the provisional amounts, such as depreciation, amortization, or other income statement line items, doing that in the current reporting period would distort financial statement results. I think that's something that's pretty easy to see in the example that we just went through. So to address those concerns, the disclosures required by the Accounting Standards Update focus on providing clarity to the financial statement users regarding the adjustments made. The FASB decided that an entity should disclose the amount of the adjustment to provisional amounts in the current period income statement that would have been recognized in prior periods as if the adjustment had been recognized as of the acquisition date. The disclosure is required for each affected income statement line item, and it may be presented separately on the face of the income statement or in the notes to the financial statements. ASC 805 continues to require disclosures of the reasons why the initial accounting is incomplete, as well as disclosures of which assets, liabilities, equity interest, or other items for which the initial accounting is incomplete. Finally, the standard continues to require disclosure about the nature and amount of measurement period adjustments recognized during the reporting period.
Does the standard provide for any differences between public and private entities?
There aren't any provisions in the update specific to public and private entities outside of the effective dates. However, some good news is that because the information is being provided through disclosures rather than retrospective adjustments, SEC registrants will no longer have to file revised historical financial statements in order to reflect material retrospective adjustments when they're doing a capital raise or filing a registration statement. So, speaking of effective dates, when do public and private entities have to adopt this guidance?
Sure. So, for public business entities, the effective date is for annual and interim periods beginning after December 15, 2015. Early adoption is permitted if financial statements were not issued. All other entities should apply the guidance effective for annual periods beginning after December 15, 2016, and interim periods beginning after December 15, 2017. Once again, early adoption is permitted if the financial statements were not made available for issuance. For transition, an entity will apply the changes prospectively to adjustments of provisional amounts that occur after the effective date.
So that's all the time we have. We'd like to thank you for joining this podcast today. We hope that the information provided gives you some insight into Accounting Standards Update 2015-16. You can find additional information on this update or other accounting standards issued by the FASB through our Defining Issues publication on the Financial Reporting Network website. which is also where you can find additional podcast and thought leadership publications on a host of other accounting topics.